Welcome, Martin Straith here, and we're here to do another one of our 10-minute trend timers. So, series of short videos help investors understand what is driving these markets. So, we're looking to give you ideas on how to thrive in the markets and techniques on how to protect your investment. So, today's topic is from a similar question from a number of people over the last week. I'm fairly new to investing. After seeing the market's dramatic decline last week, how do I protect my investment? So really what we're talking about here is hedging strategies. And when you're investing, risk is inevitable. Sometimes it's lower risk, sometimes it's higher risk, but it's always there. And the real question is, how do we manage it? When you buy a home, you typically are going to buy fire insurance in case you have a fire that damages or even destroys your home. Well, think about the same thing for hedging strategies for your investments. You want to protect your portfolio. So it's a strategy used to reduce or eliminate risk of adverse price movement of an asset. So let's look at the cost of not hedging. Back in 2000, 2003, we had the dot-com crash. During that cycle, over 3 years, we saw the S&P 500 lose 48%. Then we had the financial crisis in 2007, 2008. In 2 years, just in 2 years, the S&P 500 lost 57%. And then more recently, during COVID, very short crash, 3 months from February 2020 to April, but the S&P 500 lost 34% in those 3 months. So very important to have a strategy to protect yourself when these kind of things happen. Now, how do you protect yourself? How do you hedge? Well, there's another different processes you can use. There's options and futures. So what you're doing there, you can buy option and future contracts to lock in prices to limit, potential losses. Now, back in after the financial crisis, 2007, 2009, we had a number of our subscribers who did not sell when we said sell. And what they said is they didn't want to sell their stocks. They wanted to hang on. And they ended up, most of them, riding that crash all the way down. So what we did is we started our Trend Technical Trader because we wanted to give them a service that had good hedging strategies. When we first did that, we did use options and futures, but we found that most of our subscribers, they didn't want to learn that stuff. They didn't want to learn the new terminology, new techniques. So what we've done since then is we've really simplified it. We're just using inverse exchange traded funds, very easy to trade, just like any stock. You've got a symbol and you can buy and sell anytime, any day when the markets are open. And those are just simply, they're inverse ETFs that they gain value when the underlying market declines. So effectively, you're protecting against drops. So here's an example. Here's one that we've used quite a bit in the trend letter. ProShares short S&P 500. So the symbol is SH, and it's just simply a one-to-one inverse hedge against the S&P 500 on a daily basis. So how that works is simply if the S&P 500 declines 1%, SH will gain 1%. Now, obviously, it works the other way around as well. So if the S&P 500 gains 1%, then SH will decline 1%. And you also have to understand that over longer periods of times, especially in volatile markets, that daily compounding is going to kind of lead to some discrepancies from that one-to-one ratio. So as time goes on, it won't be a one-to-one exact ratio anymore. So if we look at some examples here, so the financial crisis, so we said back then, financial crisis, the S&P 500 dropped 57%. But if you had invested in the SH as a hedge, you would have actually gained 73%. So this is when the S&P 500 started to decline. This is an inverse, so it started to rise. Over that 2-year period, this gained 73%, while the S&P 500 dropped 57%. So it not only did it, was it a neutral gain play, it actually gained you an extra 16% over that decline if you held both of those. We also talked about the COVID. COVID had a crash 34% during that period. While you had that, well, if you used the SH as a hedge, you would have gained 42%. So 42% while the S&P 500 dropped 34. So you actually, again, not only went neutral, you actually gained an extra 8% there if you kept both of those trades on. So there's a number of different ways you can do these. I'm just going to give you some examples here. So one-time inverse ETFs, there's ones for all kinds of. Now these are just pro shares. Lots of the providers have there's a number of these out there. So here's the S&P 500 one we just talked about, SH. So that's a one-to-one inverse of the S&P 500. If you wanted to do the same idea for the NASDAQ 100, the symbol is PSQ. And we could also do the Russell 2000 small caps, and that would be RWN. So again, Russell 2000 drops 1%, the RWN will gain 1%. Now you can also add leverage. You can have it 2 times ETFs. So you can do an ultra short S&P 500. So SDS is the symbol there. So now you're talking that if the S&P 500 drops 1%, SDS would go gain 2%. Same with the NASDAQ. If you wanted to play the NASDAQ 2-to-1, you got QID. And if you wanted to play the Russell 2000 2-for-1, you got the TWM. Now, if you really wanted to get heavily leveraged, now this would be very speculative, and you'd only want to be doing this if you were really confident that the markets were going to have a significant decline. And here you got the S&P 500, SPXU would be 3 times. So again, if the S&P 500 were to drop 1%, the SPXU would gain 3%. If you wanted to play the NASDAQ, it's the SQQQ. And if you wanted to play, say, the short mid-cap 400, it'd be the SMDD. So there's just, giving you some ideas on some general ones that you can use. Now I'm going to give you another example here. Here's one that our technical trader just put on just recently. So what happened here is we had virtually zero volatility happening in the markets. The markets were down to historic low levels of volatility. Our models triggered that is getting the markets are very overbought. So what we did there on Technical Trader is we bought the VXX, which is really a play on volatility. So on May 28th, we applied that hedge. And now you can see that the volatility actually even dropped a little bit more. But just, within a month or so, that was the end of that. That was basically, there was no more buyers. And then the markets just skyrocketed. The volatility just skyrocketed. It went from, I believe, around 12, which is near a historic low, up to over 60 in just a few days. So what we had here is they bought it on May 28th at 44.84 and sold it 9 weeks later at 90.08. So that was a gain of 101% in just 9 weeks. And so it gives you an idea of how powerful these things can be. So you want to have a hedging strategy. Conclusion, simply, well-planned hedging strategy. It's not just a safety net. It's a necessary component for any smart investment plan. So hopefully we got around 10 minutes here. Give us your feedback. Send us any scenarios you would like to see explained. If you got any questions about our services or what the hedging strategy or anything else, info@thetrendletter.com. If you want to check out and subscribe to our services, just go to thetrendletter.com and hit the subscribe buttons there. And again, for these videos, click your subscribe button. And if you happen to like the video, you just click the like button. All right. So thanks for tuning in. Until next time, keep your head on a swivel and take care out there.